Tariffs will play out differently in different countries. For the United States, the tariffs represent a supply shock that reduces productivity and output permanently and increases price pressures temporarily. This adds to an already weakening outlook and leads us to revise growth down by 0.9 percentage point to 1.8%, with a 0.4 percentage point downgrade from the tariffs only, while inflation is revised upwards. For trading partners, tariffs act mostly as a negative external demand shock, weakening activity and prices, even if some countries could benefit from trade diversion. This is why we have lowered our China growth forecast this year to 4%, while inflation is revised down by 0.8 percentage point, increasing deflationary pressures. All countries are negatively affected by the surge in trade policy uncertainty as businesses cut purchases and investment while financial institutions reassess their borrowers' exposure. Uncertainty also increases because of the complex sectoral disruptions that tariffs could cause up and down supply chains, as we saw during the pandemic. The effect of these shocks on exchange rates is complex. The tariffs could appreciate the US dollar, as in previous episodes. However, greater policy uncertainty, lower US growth prospects, and an adjustment in the global demand for dollar assets are weighing down on the dollar. Risks to the global economy have increased and are firmly to the downside. First, while we are not projecting a global downturn, the risk it may happen this year have increased substantially from 17% projected back in October to 30% now. An escalation of trade tensions would further depress growth. Financial conditions could also tighten as markets react negatively to diminished growth prospects and increased uncertainty. On the flip side, growth prospects could immediately improve if countries ease from their current trade policy stance and promote a new, clear, and stable trade environment. Addressing domestic imbalances can also help raise growth while contributing significantly to closing external imbalances. For Europe, this means spending more on public infrastructure to accelerate productivity growth. For China, it means boosting support for domestic demand, while for the US, it means stepping up fiscal consolidation. Turning to policies, our recommendations call for prudence and improved collaboration. Let me outline some key ones. First, an obvious priority is to restore trade policy stability. The global economy needs a clear, stable, and predictable trading environment, one that addresses some of the long-standing gaps in international trading rules. Monetary policy will need to remain agile and respond by tightening where inflation pressures re-emerge while easing where weak demand dominates. Monetary policy credibility will be key, especially where inflation expectations might de-anchor, and central bank independence remains a cornerstone. Many fiscal authorities will face new spending needs to bolster defense spending or to offset the trade dislocations likely to come. Some of the poorest countries, also hit with reduced official aid, could experience that distress. Yet debt levels are still elevated, and most countries still need to rebuild fiscal space, including by implementing structural reforms. Support, where needed, should remain narrowly targeted and temporary. It is easier to turn on the fiscal tap than to turn it off. Where new spending needs are permanent, as for defense spending in some countries, planning for offsetting cuts elsewhere or new revenues should be made. Finally, even if some of the grievances against our trading system have merit, we should all work towards fixing the system so that it can deliver better opportunities to all.
If you like the video, do like, comment, share, and subscribe. If you like the video, do like, comment, share, and subscribe.